You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Podcast Series.
Moritz Siebert and I, Niels Kostrup-Larsen, are back with this week's edition of the Systematic Investor Series, where each week we give you a raw and honest account of what it's like to be a rules-based investor, what news and articles caught our attention, and of course, where we also attempt to answer all of your questions. Good afternoon, Moritz. How are you doing today?
Good afternoon, Niels. How are you? Rainy weekend. Not only a rainy Sunday, it's a completely overcast rainy weekend, so I don't mind hanging out with you and chatting about the markets.
Absolutely. Let's do that. And just for everyone's benefit, today it may be a little bit shortened episode, but that is just due to some other things that we have to take into account on today's recording. But anyways, 2020 keeps surprising many investors, and Friday's May jobs report, which showed a net increase of 2.5 million in the payrolls number and a 13.3% unemployment rate versus the consensus of 8.3 million jobs lost and a 19.5% in unemployment rate, is just the latest kind of surreal development in what can only be said is already an unusual year that won't be easily forgotten. And if you look at the level of the VIX, you probably wouldn't think that this year we've had the highest level of volatility in history. But I will just say that I have seen some reports on social media that there is some kind of error in the May jobs report. So let's see how that all plays out. Nevertheless, the market seems to be liking what they see, and we've already, of course, enjoyed a very sharp V-shaped recovery. And this lasted all the way into this weekend. It also meant, by the way, that some of the safe haven markets like FX and gold, fixed income and gold, got sold off by investors. And although we did see a little bit of strength in the dollar on Friday, it was actually a week where also that got sold. Energies, another strong week. And all in all, this week, as we will talk about shortly, inflicted more pain on trend following strategies. And of course, we will also explain why this is quite normal. And that's what often happens when we see these V-shaped trend changes. Of course, we have to look at the bigger picture. 2020 has perfectly demonstrated why all stock and bond portfolios and investors need trend following in their portfolio, as this combination of these investments have really helped each other out this year so far during the ever-changing environment. So with all of that said, Moritz, dare I ask how your week was? I've already said it wasn't a great week for any of us.
Yeah. Well, you know, those weeks are part of the spectrum of trend following. There's just nothing you can do about it if you follow your system. I've lost a bit more than 3% in this past week. Now negative for the year for the first time, minus 2.65% year to date. As is so often the case, you know, we've said it before, the short-sided trades, they don't produce much of the winners, but they sometimes tend to cause a lot of the losers. And all of the losing stuff this week comes from short-sided trades, short crude, short copper, short sugar, short coffee, short emissions, short yada, 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 right? And none of that stuff has essentially worked. I didn't really, I had a handful of winners, but none of them substantially large, like, a long position in orange juice, a long position in rice, but none of that really covered the massive losses from all those other positions. So it is what it is. A couple of trades. I mean, I had a short S&P position on. That one got stopped out. Well, so be it. Covered a short in the Aussie dollar, covered a short in the Euro stocks as well. So some movement in the portfolio. And, when I speak to people in the markets, the feedback that I get is that everyone is still or continues to be extremely perplexed about the strength of equities in the recent weeks. It's just a relentless move to the upside. Who would have thought that? I mean, the NASDAQ is now at an all-time high. The S&P is positive for the year. Forecasting these markets is pointless, in my opinion. Like you've just alluded to the jobless figures, Niels. I mean, the forecast is X, and the result is so far away from X that it's not even in the same ballpark, right? So it's incredibly volatile. what I hear is that because it's so volatile and so uncertain, a lot of people have stayed away from reallocating to equities. I mean, yes, there has been some reallocation going on, but what I hear is that a lot of the institutional money is still sitting on the sidelines, and they were kind of like, no, I don't trust this bear market rally. This will make another leg lower, and maybe it will, right? For now, it doesn't. It's moving higher essentially every day. So at what point are people going to scream uncle and just throw in the towel and buy? And then who's to say that we're not going to be 20% higher by the end of the year on the S&P 500? As surprising as this may be, as far away from valuation, whatever valuation is, this may be, or whatever people use as their metrics to determine whether prices are fair or not. To me, those episodes, they're always, again, a reminder to not overthink it, not forecast those markets. Yes, follow the systems, put those trades on. You will have a losing week like I did this week. But having a view on what these markets are going to do tomorrow, next week, next month, oh no, I'm not doing that.
I obviously completely agree with all of what you said. I want to, before I walk through our week, I want to pick up on what you said, because I think there's a couple of really interesting points that you can transfer from what we do on a manager level to actually what you can do as an investor. And what I've certainly seen this year, speaking to the point you said about where some investors are completely perplexed, they're not allocated enough to the markets right now, so they may be the ones now being forced to buy the new highs, and I wouldn't be surprised that then is the new high, and then we get another surprise. Anyways, certainly what I've seen with some of the, what I would call the smart investors that I come across, is that they were as disciplined as we are when it came to what they had to do during the COVID sell-off. So what they did was they sold the things that had not lost their money, including CTAs, and they bought the equities because they kept rebalancing their portfolio to keep that asset allocation that is so useful, so helpful for them over time, but which has also meant that in the last few weeks, now they're doing the reverse. They're lightening up a little bit on the equities and they're buying back the CTAs. And I think that is really smart, and that's what you should do. You don't necessarily have to do it this frequency normally because the moves are not that great. But in a case where you get a 35-40% sell-off in equities, yeah, you definitely need to go and rebalance. But, this is the same kind of discipline as what we do in our trading. So for these kind of multi-asset type portfolios, they're probably having a decent year now because they got some cheap equities into their portfolio at the right time. And it didn't really cost them a lot or as much on the downside because they had things such as CTAs, probably maybe some gold, I don't know. But they had other things that had not lost that much on during the heat of the crisis. And so perfect example of how you can instill discipline on all levels of investing, not just on the manager level. Anyways, to go back and answer the question, yes, I mean, we certainly also had a rough week this week with this complete V-shaped move in many markets. I was looking at the portfolio, we trade 55 markets, 45 of them lost a bit of money this week. So clearly one of those weeks. And we'll see. It doesn't mean that exposure has flipped completely. It's not like we're suddenly long equities to a large extent or anything like that. But of course, during a week like this, positions gets adjusted accordingly, and we live to fight another week. And that's the way it's always been. Other than that, not much I can add to your weekly recap. But I did want to pick up on some of the things because, as we say, it's been a rough week. It's been a rough maybe few weeks for some of these quant strategies. So I wanted to pick up on an article that I found on Bloomberg, and where the headline was "Fast Money Quants Gets Whiplashed in Ferocious Market Rebound." And I think the article highlights a few points that we talk about, but why don't we dig into it as a good recap of some of the things that we often come across. So first of all, it talks about how quants has suffered in this bear market rally. It says Wall Street bulls are back with a vengeance. No doubt about that. We're all aware of that. And then it talks about, first we had the quickest correction on record during the Corona crash. And now since then, we've had probably the quickest rebound also in history. And then they go in and talk about some of the sectors. Despite, in addition to equities, we've seen now the 10-year Treasury yield is starting to rebound, moving up at a decent pace. The euro is suddenly breaking out to the upside after a long downtrend against the US dollar. They also talk about the SocGen CTA index tracking the cohorts performance. And now we're the cohorts. It's down 3% for the year. I'm not entirely sure which index, whether it is the trend index, but the trend index is down a couple of percent for the year, so it's not too far off. But they also talk about how there's been $28 billion redeemed from CTAs as of April. One positive thing they do say is that these systematic managers who speculate in futures markets are still beating hedge funds overall. So that's nice. But of course, they also point out that the performance is a far cry from the 2008 crisis alpha. I mean, I think already there, we can start there. Moritz, the tone is set. These journalists who were very quiet during the month of March, early April, they're back now, making it sound like it's just another example of how these strategies are not working. But as you and I often talk about, they're actually working exactly as they are designed to do. And as I talked about a few minutes ago, for those who had them in their portfolio, they played a very pivotal role during the crisis. And okay, now they're losing a bit on that part of their portfolio, but they're making a lot more on the other part.
These articles, they sound a bit like, trend following CTAs have the wrong positions on.
Right.
And I think this is there's a difference there that we need to distinguish. I think we have the right positions on. They're just not producing the positive P&L at that point in time. But I think the positions that I have on, they are the right positions. They just happen to lose money at that point in time. When I look at a lot of the macro forecasts from global macro, people that we enjoy listening to, for instance, on Real Vision, or we read reports, right? I mean, they're saying, well, this is a deflationary period. Equities need to make a leg lower. This is, yes, it is a V-shaped recovery, but it's a bear market rally. The US dollar needs to go higher and bond yields will go lower. This is kind of like the positioning of my portfolio. It's just not making the money right now. But this isn't to say that, hey, maybe we're going to have another week, another 2 weeks, another month of suffering with those positions, and then we'll change. But who's to say that maybe, in a week or 2 weeks' time, we'll be up 5%?
Yeah, and you're absolutely right. You're exactly right, actually, in terms of how a lot of these global macro guys who don't necessarily use any kind of trend following models to come up with their current asset allocation. And of course, Raoul Pal has been quite right on a lot of his calls leading into this. It is quite interesting that at the moment you could say to some extent that our positions are quite similar. And therefore, of course, only time will tell whether this is quote unquote a bear market rally or whether this is the beginning of something very different. Of course, when you look at the numbers, it's very hard to understand why equities would be making new highs as they have already started to do again. And as you said, S&P up for the year now, given the underlying economic conditions. And so it'll be interesting to see how, certainly in a year where there is an election in the US as well, I mean, the political part of all of this, when you get huge dispersion between the rich and the poor, I don't think should be ignored. And of course, I think if GDP falls as much as is forecasted by some of the local feds, you're going to see the Buffett ratio, which I think is just like value of S&P over the GDP, US GDP. That ratio is going to blow out completely to levels we haven't seen before. And that might create even more tension in a country where you already see tension on the streets every single day, which will then make itself back to the markets at some point. So we'll see. I mean, it's still early days. And as you and I were talking about just before we got on, when I look at the four big crises, 87, tech bubble, great financial crisis, or at least those three, which of course are finished, and I look at our own performance during these periods, it was strong through all three, but it didn't come in a straight line by any means of the imagination. I mean, sometimes we started losing money in the beginning of the crisis, and then we would make it up towards the end of the crisis. Sometimes we made money in the beginning, then we gave back quite a bit of it, and then we made it back plus some towards the end of the crisis. You just never know. And as you rightly say, not having any prediction in your portfolio, is probably a good idea in a world where even if you are predicting, you might be incredibly wrong, as the jobs numbers on Friday told us.
I think this is exactly the right way to look at that, Niels. Look, I mean, I'm down 2.65% for the year. Roughly flat, I would call that, given my volatility, right? I mean, this could be up 1% by the end of next week, or up 2% by the end of next week, or down 5, who knows? But I mean, what it shows, when I step back from it, it's kind of like we're closing in on the half year mark for this year. So I'm roughly flat with the portfolio, right? Okay, fine. No big damage done. I mean, I'm not down 30%, right? But what I need to put in front of my eyes is if I didn't have a system, if I didn't have a model that, tells me when to do the trades, and you've used the phrase live to trade another day, which is so important, right? Surviving all of this. If I were a discretionary trader forecasting those market moves, I probably would have freaked out, or very, very likely freaked out with the correction in March or end of February till the end of March, right? And by all likelihood, I'd be down substantially more as an equity investor, throwing in the towel at, the worst possible time, predominantly or presumably. So these models aren't bad. We have the right positions on, and it's like you say, they don't immediately produce the P&L that we want them to produce, but depending on how that year develops further, maybe we'll have another great leg.
And also, by the way, speaking of the central banks and all that, I mean, right now it looks like what they did was great and they have it all under control. But regardless of how much money they print, they can't print jobs. And so let's see in a few months how that all looks like in terms of joblessness.
Yes, and I guess this is what many people are so puzzled about, is they look at the world and they see all those possible conflicts, all those problems, right? The euro in Europe, the tension in Hong Kong, or the oil markets, tension in the US, jobless quotes, GDP, recession, depression, inflation, deflation. I mean, you name it. You can write a book about what's going on and it's all essentially negative, right? But there's this one thing, which is a central bank. And they just, open the floodgates, print the money, or, stabilize the system, flood it with liquidity. And maybe it is as simple as that, if there is this thing with this firepower and they support the markets, then, well, just don't get in the way of it.
Yes.
Of course, we don't have that programmed into our systems. I have nothing in my system that says here's a response function to central bank action, right? It seems to be like, hey, there's this thing, the central bank, which is essentially providing free puts to everybody. So let's just take it.
Yeah. And I'm sure some people probably have modeled that into it because you can. But what's interesting about that is that I saw some stats that during the initial QE phase, you could say, okay, for every $20 billion they would print, it usually meant 1% up move in the S&P or something like that, right? But now with the velocity of money just, falling off a cliff, now they have to print like 5 times that amount to get to 1% up move. So it becomes kind of silly money.
And who will pay that back?
Well, the thinking I have is that, and what seems to be going out of Twitter, I mean, if you can print money without consequence, why don't you print more and then people don't have to pay tax?
Yeah, exactly. I mean, there's, all the new ways of thinking about stuff, right? But in our standard double entry bookkeeping world, if you're printing that debt, there's some entry on the other side of that balance sheet. So who's paying that back? My kids, your kids?
I wonder whether that's why
Debt Jubilee
Fed
defaults.
Yeah, well, the Fed doesn't want to be audited, so
no, and that's because they're independent, right? You can't go to them, right? And they go well, price stability. So price stability means, I think this is the stance in Europe with Lagarde, close to but not higher than 2%. And I've always been puzzled by that because you and I know what compounding does, right? If you're compounding 2% for 10 years, I mean, that is definitely not price stability, right?
Right.
You're behind more than 20%. So I don't get it what they want to do there. Maybe this entire construct of how central banks work and what they do and what their purpose is in economies will be rethought at some point and maybe replaced by some new ideas. I don't know. But I mean, it seems to be that it's recurring all the time. We're getting these problems, and the central banks need to, firefight it. And at the end of the day, it doesn't work, and currencies stop existing or they become completely devalued, and then we do it again.
Well, since we are kind of off topic today, anyways, let me just throw one more thing into it. When you say that maybe these institutions will they'll rethink how it operates, I can only suggest that everyone goes and watch the documentary, I think it's fair to call it, on Real Vision with Grant and Neil Howe. Essentially, Neil Howe and one other gentleman who I forgot the name of wrote a book. Right, wrote the book, The Fourth Turning, and we are in the fourth turning right now. It started around 2008. It's going to last until 2030, about 22 years. And then there is another 3 generations, and then you get back to the fourth turning. So, but if you go back 4 generations and you look at what happened back then, which is, of course, around the First and the Second World War, things did change, and authorities and institutions were rethought and changed. And so, yes, I mean, I think that's exactly what's going to happen in the next 10 years is we're going to realize that it doesn't work. And then they're going to come up with new structures. So, yeah, on that point, I think people should watch that because it's a very good illustration of how society works and changes.
And I can only recommend for those who have access to, well, you don't even have to have access to Real Vision. There's a professor out there, a gentleman, German guy by the name of Richard Werner.
Yeah.
He lives in the UK. He used to live in Japan. He's an economist. He's written a book called The Princes of the Yen, which I had never heard of. I only picked it up because I watched Hugh Hendry on Real Vision, and he brought it up. There's also a documentary on YouTube, which people can, it's about, an hour 15 or something like that, which people can watch, which I found absolutely fascinating because it zooms in on the way the Bank of Japan and the Japan Ministry of Finance, how they collaborated essentially after the Second World War to stimulate the Japanese economy and what problems that caused. And it gets you thinking about what central banks can do, what's in their armor, and how manipulative they can be for prices, for credit creation, and all of that, right? And I just thought that if this is happening again, people aren't stupid. They can read the books of the history books, right? And they can ascertain that, hey, this kind of like happens, like the fourth turning comes every 100 years or whatever it is, right? It happens over and over and over again in the same manner. Currencies stop existing, they become devalued, there's a flight to gold, right? And kind of like the system resets. Are they going to accept it the next time that some government or some elected officials are saying, well, we're going to put up another central bank and now we're going to do it this time? Or will they go, no, we've got enough of this. We're doing it decentralized with the electrodollar, crypto, Bitcoin, whatever the case may be, but we've got enough of that, central bank. There's like this mystical institution in the middle that tries to guide us, but to be honest, it never works. It always ends in failure.
Well, let me pick up on that just for a couple of more minutes, and that is what was really interesting about that documentary that is based on Richard Werner's book is the fact that since he lived in Japan at the time and was part of, you kind of could see it from the inside, what actually took place, and think about that when you think about what's happening right now. What took place was that the BOJ, the Bank of Japan, kind of engineered the bubble. And so when it all went wrong, what usually happens when these things go wrong is people will say, oh, well, we need more independence for the central bank. So that was their aim all along, was to actually make political reform and change to make them even more powerful, more independent. So they engineered the bubble in Japan. And just look at what's happening with the Fed right now, and what would happen if this ends badly. Will the Fed get even more independence? And one more thing, because I know you're burning on this topic as well. The most independent central bank in the world is
ECB.
the ECB.
Exactly, and it's because we're systematic traders. This is kind of like for us. This is I enjoy reading about these things, but it's not related to my trading and my positioning, right? So it's kind of like a hobby. You're interested in those type of things. But like you say, in Japan, they had this concept of window guidance. So it's a cooperation between the Ministry of Finance and the Bank of Japan. And the Bank of Japan wasn't all that independent, right? And here in Europe, the ECB, by statute, is completely independent. You can't get to that organization. They're not liable. They're not accountable to anyone. They don't have to show their books or records, right? They're completely above the law, essentially. And this is why, we just, I think 2 weeks ago, we had a ruling here, a high court ruling in Germany about the legality of, those bond purchasing programs. Essentially, it doesn't matter what a German court says. This ECB institution just sits above the law, and Lagarde will say, well, nice ruling, I'll read it, I'll consider it, but it's not going to impact anything here at the level of the ECB. So these organizations, they're fascinating in a bad way, maybe.
And I'm going to need your help here with some German pronunciations here. Because what's fascinating about that story is that when they created the ECB, they did not model it on the old Bundesbank.
The Reichsbank.
They modeled it on what was before, which was the
Reichsbank, yeah, which was completely independent.
Exactly, and the Reichsbank, of course, was the one that played a pivotal role in what happened leading into the World Wars and during the World Wars. But when they created the Bundesbank, they made a big change. They made it accountable to the parliament, even though we as market participants, because I remember this very clearly as a young government bond trader, having to pay attention to every single move of the Bundesbank. The Bundesbank was prudent, it was sensible, it was hawkish when it needed to be hawkish, etc., etc. And it all felt like they were incredibly independent. But the truth is they weren't, because they had this responsibility to the German parliament. But then when the ECB came along, they said, no, we can't do that. We're going to make it completely independent, going back to the Reichsbank's model. Yeah. And oh my God, that sends shivers down my spine to think that that's actually what they did. And now you see some of those things happening in front of our eyes where they just don't care about anything.
Exactly. And, I think those discussions and the details of all of that, they're certainly above my pay grade. And I don't want to give people the illusion that I'm in detail knowledgeable about central bank policy. I'm really not, right? So I'm just picking stuff up, and I find it interesting to listen to alternative and different opinions, like the one by Richard Werner, right? Which gives you a very different perspective on how that stuff works. And you can read Ray Dalio is putting out some great papers on LinkedIn about the history of money and the history of credit and how those debt cycles work, right? And how they always bust. And I just think that if we're in this fourth turning and this happens again, and people read the history books, because all that information is now available, right? Just click on the internet, you find it all. It's all there. Ray Dalio writes about it. Are we going to accept it that we're just going to do it in the same way again? So yeah, let's devalue it all. Here's a new central bank. Let's call it whatever central bank, and go again on another 100-year ride. I'm not so sure.
But you know what, Moritz, on that point, the reason I think it happens again and again and again is this didn't happen to you and I. It didn't happen to, it's not happened to our children yet. Meaning that even though we can read about it in history books, that it did happen and we shouldn't let it happen again, because it didn't happen to us.
That's right.
Our memories are just not strong enough to avoid it. So this is probably the reason why people refer to the quote that history may not repeat itself, but it sure does rhyme. And it's going to rhyme pretty soon, I think. But there we are. Certainly off topic today. If you like these kind of global macro discussions, maybe we should get Raoul Pal on the show one day and take a step away from just pure trend. But anyways, back to pure trend. We have a couple of questions before we finish off this shortened episode. Abhishek writes in. This is right up your alley, Moritz. He writes in, first of all, thanks so much for those great and informative episodes. Question: how to solve the problem of futures rollover cost? Price of far months contract being higher than recent month contract. Is there an effective way to roll over the futures contract to reduce the cost? What say you?
What say I? Well, so the situation that is being referred to here is a situation of contango, which is a steep futures curve, meaning the contract farther out is trading at a higher price than the current contract that is about to go into expiration. Now, if your roll schedule, if your system is such that, it rolls from the front contract to the second contract, then that is what you do, and you're very likely to incur that roll loss. Let's make the example of crude, right? Crude may be trading at around 40-ish, I think now, or 38, whatever, right? And the next contract out is a bit higher than that, right? So you're buying the next contract out at a higher price. If really nothing changes in the oil market and just 1 month passes and goes by, you will have lost money even though the actual price of oil didn't change, right? So this is the cost of rolling into a contango scenario. Now, you can look at markets that have a more liquid term structure farther out and try to find points on the curve that are less affected by negative roll yields, right? For instance, you can decide to trade less often, to roll less often, or to find a price or a point on the curve that is less contangoed than the one that is at the front of the curve. So there's a couple of ways to think about it, but I would always systematize it. What I'm not doing with my system is I don't have it produce a signal that tells me, hey, it's time to roll a market, it's time to roll out of crude now. I don't then look at the curve and say, I'm going to now roll into this contract. I have my system designed that for me, so it's rules-based. But of course, these rules can be programmed, and I'm doing that. I have a look, like a systematic look at the futures curve, and I'll try to find contracts which have the right liquidity, which don't require me to roll all the time, because there's also a bit of a spreads that you pay and commissions that you pay every time you roll, and which try to find a good point on the futures curve.
Yeah, I've got nothing really to add, Abhishek, to this comprehensive answer from Moritz, but I will say the importance of not also trying to be too clever about it is that we always preach that you should test what you trade and trade what you test.
Correct.
So as long as that roll sequence that Moritz talks about, which is more or less fixed, is in your test and you're happy with your test, just trade it, because you don't know what's going to happen in the future.
Correct. Yeah. And don't worry too much about like one single roll.
Yeah.
If you're trading a diversified portfolio of futures contracts, likelihood is that, some markets are going to be in backwardation, some markets are going to be in contango, and you're going to do it more than once, right? Your life does not depend on one roll. The crude oil market may be in contango now. It used to be in backwardation, 6-7 months ago, or even less than that. It may be in backwardation again in a couple of months' time. Who knows, right? So it's just one roll. Just do it.
Yeah. And of course, if you're a short-term trader, it has no impact anyways, I would say. Next question is from Tim. I had a question for the podcast. When you're tracking the performance of an account designated to a CTA, like trend following strategy, how often do you measure the performance? Daily, weekly, monthly? I understand it would depend on if you're short or long-term trend following, but it seems like you could go weeks or months without closing a position. So in essence, your realized P&L for the account could be 0 for month if you didn't close any trades. Or would you use the unrealized P&L for the whole account on a continuous basis to track performance? Thanks very much. I mean, Tim, let me start on this one, Tim. I mean, at the end of the day, it depends on what you're using it for, right? I mean, if you're really interested in what happens on a daily basis, just track your P&L every day. Some people look at it just once a week, how did I do? And that's perfectly fine as well. If you're a professional money manager like, we are, we have to track it daily. We also track it intraday to make sure everything is okay, but it doesn't mean a lot other than these are certain things we have to do for our own kind of both compliance but also risk management purposes. And of course, we have certain reporting standards we have to adhere to, both to clients and for regulatory purposes. But if you're doing it for yourself, I mean, I wouldn't go months without looking at the P&L. I don't think that's sensible. And of course, you would want to use the unrealized P&L to get an accurate picture of your performance. So that's what I would say. Anything to add to that, Moritz?
Not much. I mean, what I would like to say is I think it's, at least as far as I'm concerned, it's good for my mental trading health, so to say, to definitely not look at the intraday price action of my trend following trading system. There's just nothing that you can gain from that. There's really no added value. I think for the trend following trading stuff, I'd be happy to just have a look at the P&L on a weekly basis and see, okay, this is what it did, right? And then review the markets and the price action on the weekend over a cup of coffee on a Saturday. But like you, Niels, I want to make sure that, my system actually runs the way I want it to run, that there's no errors, no quirks, no, failures in the process. with communication to brokers and, things like that. So I tend to give it a look on a daily basis just to make sure that all the lights are still on green. But, a single day's performance really isn't that important.
No, absolutely. Final question for this week is from Carl. Carl writes, as usual, great podcast. Thanks so much. I have allocations to different diversified funds, system strategies, and instruments. One of the funds I trade long-term in and out value stock, it brackets value stocks, in the UK using a trend-following strategy using a weekly SPY chart. I have a small account with IB, which I want to trade, grow, and learn from. I have an issue of not being able to trade all signals as it's not a margin account. Question, how many stocks or trades at 0.5% equity per maximum in one account or maximum percentage of my account? I think, okay. As Jerry has said, would it be okay to pick an uncorrelated bunch and trade them? How do I find/choose uncorrelated stocks? Yeah, and then if I have too many signals, to adjust it with the trades I'm in. Okay, so a little bit about how to deal with essentially an account size where you can trade more than you can in reality, I would say seems to be one of the questions, and also how many positions to put on at 0.5% risk, so to speak, if that makes sense. Do you want to go first on this one, Moritz?
Yeah. So just to clarify maybe one thing here, I think I understood that he said it's not a margin account. So if it's not a margin account,
that's right, he has to pay in the full amount.
So that means he cannot get leverage. Right.
Correct. In this case, on the equities,
in this case,
it sounds
right?
like it, yeah.
So let's say you have $100, just for argument's sake, to keep the calculation simple. You have $100. If you invest $100 in equities, that's 100% exposure. There's no leverage, right? Then you have the risk of, say, the S&P 500 if you're buying the SPY, for instance. Now, if you purchased 200 stocks and each stock has 0.5% equity allocation, then no leverage, because 200 times 0.5 is your 100% exposure. So if this is what he's doing, he could buy 200 stocks and give every single one of them 0.5% risk. Now, let's differentiate that from the way we trade, because we use futures contracts, we use leverage, and we therefore have a different way of thinking about that risk when we take on a position, right? So if we take on 0.5% equity risk, we would position is sized such that, for instance, when it goes into its stop loss or its exit, it will have lost 0.5% of our equity, but the position itself may be very much leveraged, right? This is how we do it. I guess it's difficult for me to answer the question precisely here.
Well, what I would say is that if you don't use leverage, 0.5% risk is probably too little anyways, right? So it doesn't make sense to trade 200 stocks with 0.5% exposure in each, because it means that the stocks has to go to zero before you lost 0.5%, which some might do. We know that can happen, but not all of them. In that case, I think if we understand you correctly, Carl, here, I think if you're trading without leverage, it probably makes sense to have a fewer positions, but bigger position size. It could be, and I'm just throwing something out, 2, 3, 4, 5% position risk for each equity. So if you're completely wrong on a stock and it goes to zero, like Enron did, you lose 5%. Okay. But as Mark's saying, since we use leverage, we can lose multiples of 0.5% in our portfolio, and that's why we keep it probably even smaller than 0.5% in reality.
And maybe one word here on those indices. Let's not forget that, especially in the past couple of years, the major equity indices have become increasingly concentrated in a couple of names: FANG stocks, tech stocks, you name it, right? Because market cap or float weighted indices, they have like a hidden momentum behind them, right, in their weighting scheme. And the past few years have been characterized by a massive outperformance of momentum and growth over, for instance, value. So if you're buying an index such as the S&P 500, I mean, I'm not sure what exactly the 5 names are, but it's like the Apples, the Facebooks, all the tech stuff, right? That essentially gives you the exposure. Of course, the ETFs are very liquid and they're cheap to trade, but I guess there's a point that could be made that if you stay away from those indices, say you use, 20 other stocks and you give them equal weight, you probably have more diversification. And maybe you don't have to outsmart yourself there. Just, go different industries, different sectors, and just, Tesla and Coca-Cola, they will be doing different things. It's just different businesses, right? So put them in.
Yeah, and I think that to answer your question that Moritz started on answering in terms of how do I find uncorrelated stocks, well, in theory, you could just use a spreadsheet to find stocks that have low correlation, but otherwise common sense can take you quite a long way. Just look at what's happened in the last few months this year. And by the way, as one of the previous guests on the podcast, Chris Cole, tweeted out yesterday a chart about a massive reversal in momentum versus value. I mean, you probably need a little bit of both, so to speak, because they won't be the same and they certainly will be uncorrelated from time to time. So hope that helps you on your journey, Carl. Let me quickly run through, as we wind down early today, the performance of where we stand so far this month, this year. Friday was probably a down day. I think that's pretty safe to say across the board. But as of Thursday, which is when we have the numbers, the Beta 50 was down 82 basis points for June, down 305 for the year. SocGen CTA index down almost 2% for June, down 3.14% for the year. The SocGen trend index down 2.72, down just shy of 2% for the year. And the SocGen short-term traders index down 65 basis points for June and still up 3% for the year. And then finally, the Bridge Alternatives Index down 2.6% for the month and down 2.22 for the year. And in comparison, just because I have the number, the MSCI World Index was, as of Friday, up 5.53% for June, but still down about 4% for the year. Any final words today before we close down?
No, I hope for some sunshine in the coming week and maybe some better trend following performance. Other than that, no, all good.
Excellent. And as usual, keep coming with your questions to the info@toptradersunplugged.com email address, and we'll do our best to answer them on the following show. It really does make it more fun, I think, and interesting for everyone to hear where the pain points and questions are. So we love that. And as you have heard today, we may even venture into some completely non-systematic discussions, which is fun. And so you never know. We're going to try and keep it fresh here on Top Traders Unplugged. So from Moritz and me, thanks so much for listening. And we look forward to being back with you next week. In the meantime, happy trading and take care.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.